I'm betting most of you didn't realize Gap is one of the most underrated turnaround stories in retail right now. Stick with me because by the end of this video, I'm going to give you my growth value risk score on Gap and why this stock might be flying under your radar. The company has been in a bit of a rough patch lately, no doubt about that. But now it's starting to gain some serious momentum. And if you're not paying attention, you might miss out on a big move. Gap's management has been super focused on getting those margins to grow and driving up earnings, which means their stock price could be headed north sooner than people think. Now, when we look at the growth, Gap's expected to get back on track with some low single digit growth by 2025. Not mind blowing growth, but steady, and in retail, steady is gold. This growth is going to come from the company's ability to expand its adjusted earnings margin. It's one of those cases where as the business picks up steam and they become more efficient, they're able to make more profit off each dollar they bring in. Now let's talk about what makes Gap interesting. The company's got four big brands. Most people have at least heard of one: Old Navy, Gap, Banana Republic, and Athleta. Now, each of these brands plays a total different role in Gap's portfolio. But Old Navy is the cash cow here. In fact, Old Navy made up over half of sales in 2023, 55% to be exact. This is the brand that's really driving their growth. And with the value conscious customer base they're targeting, it's perfectly positioned to keep winning. But don't sleep on the others. The Gap brand itself is still pulling in over 20% of sales, and Banana Republic got about 13%. Athleta, while having a bit of a rough quarter, is still strong with a solid 9% contribution. And I think that's a brand to watch, especially as the focus is on empowering women and sportswear. All right, let's get into the recent numbers. In the second quarter of 2024, Gap's total sales hit $3.72 billion, up 4.8% year over year. That's a solid beat, and most of it came from comparable sales growth, or what they call it CSG, 3% up across the board. Old Navy once again leading the charge with $2.12 billion in sales, but the thing is, Old Navy's comparable sales grew by 5%. That's 200 basis points more than in the first quarter. This brand focuses in on value, which is exactly what consumers are looking for these days with inflation and everything else that's going on. Now, the Gap brand itself also saw some nice gains. 5 quarters in a row of share growth in women's apparel. Yeah, they're hitting their stride. Athleta, like I mentioned, took a hit in sales, but most of that was because they were running heavy discounts last year. So it's not as bad as it looks on paper. The demand's still there. When we talk about profitability, Gap's in a much better place than they were a year ago. Their gross margin was 42.6% in Q2. Now here's why that matters. Margins tell us how efficiently a company is running. Higher margins mean they're either cutting costs, raising prices, or doing both. That's how they turned out in earnings per share of 54 cents, which beat the consensus estimate of 41 cents. Beating expectations is what we like to see. Execution has been tight too. They've been nailing it with product offerings and keeping up the momentum throughout the quarter. And let me tell you, Old Navy is positioned to keep winning because they know how to tap into that value market. Right now, people are looking for deals, and Old Navy's giving them just that. You pair that with Gap's steady hand in women's fashion and Athleta bouncing back, and you've got a recipe for growth. Now, Gap's management has been a little cautious for Q3. They're saying they expect slightly positive sales growth compared to last year. They're playing it conservative, but honestly, that's smart given the uncertainty in the macro environment. If things go right, like if Athleta picks up faster than expected, or they get more credit card revenue than they're projecting, there's upside potential here that the market isn't pricing in just yet. As for valuation, this is where things get really interesting. Gap's forward PE ratio has dropped from around 17 times earnings at the start of the year to just 10 times now. That's a big fall, but it also means there's room for this thing to run back up once the growth and margins normalize. If they keep executing, which I think they will, that multiple could climb again, and we're looking at a significant upside. Now, let's get into the risks. Some of the risks I need to mention include rising inflation, tariffs, especially if we get hit with a new one under another Trump administration, which is possible. Things could hurt consumer spending. Gap's business depends on people buying clothes, and if their wallets are tighter, that could slow down things. But here's the thing. Gap and Old Navy have a lot of value-seeking customers. And those customers tend to stick around even when the economy's shaky. When you combine the growth value and risk score, we're looking at an overall composite score of 18 out of 30. That's not bad, especially for a retail stock in the middle of a turnaround. If they keep executing, I think this could be one of the more underrated plays in the market right now. That's it, guys. If you liked the video, please hit that like button and don't forget to subscribe if you like more content.